We got through 1998. We got through the dot-com crash. We got through 2008. We got through 2020. And COVID, there's actually a good-sized market drawdown in 2018. Between October 1, 2018 and Christmas Eve, what I call the Christmas Eve massacre, stock markets dropped 20% in under 3 months when the Fed kept raising interest rates even though the economy was making. So they have seen those. But every single time it came back, even in COVID, March, April 2020, the stock market went down 30%. It did. I mean, just almost straight down. But by September, we were back to new all-time highs. And so it's not that they've never seen that kind of volatility, but they learned the wrong lesson, which is it always comes back. And we know why. Because the Fed bails you out.
In essence, Jim Rickards warns that history shows market rebounds after crises, but people have learned the wrong lesson, assuming every downturn will recover due to Fed intervention. He emphasizes the potential for a severe recession due to the Fed raising interest rates too quickly to combat inflation. Rickards believes the Fed might overshoot, leading to a deep recession, contrary to the optimistic Goldilocks scenario. He cautions that if the Fed continues this path while the market ignores the warnings, it could result in a sudden and severe stock market crash. Ultimately, he highlights the risk of over-reliance on Fed intervention and the potential for a significant economic downturn.
The Fed floods the zone with money. The Fed talks it up, etc. But the counterexample in 1929, when the stock market did crash, it was down 23% over 2 days. It was like 12% day and an 11% day in late October 1929, but it kept going. The stock market crashed in October 1929, but it bottomed in June 1932. That was a 3-year moving crash, or rolling crash, whatever you want to call it, with some rallies along the way. And the total damage was over 80%. Not 30%, not 40%, down 80%. And what people don't know, many people don't know, is you said, okay. Then it rallied in 1933 and 1934. The Fed messed up again and blundered again, as they usually do in 1937, and threw us into a double dip. But if you ask people, okay, well, everyone knows the stock market crashed in 1929. When did it regain those highs? How long did that take? The answer is 25 years. It was 1954 before the market recovered from 1929. It doesn't mean there weren't gains along the way, or you couldn't make money. You could. But if you say, oh, I'll just sit tight and wait till it comes back, well, a lot of people didn't live long enough. They never saw their money back because they didn't live 25 more years. So that's a real bear market. It's happened before. But the point is, you need to be prepared for things like that. And there's no one alive, but very few people alive have seen anything like that. And if you say, well, what if we had another market crash right now? We'll talk about reasons why in a second. Why couldn't the Fed just come right back in and print some more money and do the same thing over again and bail out the new failures, whoever they may be? You can just kind of keep bailing things out. Why not do it again? What's the big deal? Well, the answer is each bailout is bigger than the one before. And that's the point. You can go all the way back. 1994, Mexico 1998, Russia, LTCF, 2000, 2008, Lehman, 2020 pandemic. And they do bail out, but each one's bigger than the one before. I mean, we threw out $6 or $7 trillion of new debt on top of a $1 trillion year baseline. $7 trillion in new debt to kind of dig our way out of 2020. So there's a limit. There comes a time, it's like, hey, this bill is going to be 20 trillion. Sorry, that check is too big. We're going to have to let some things fail. So what could happen? The first thing on my list is we're heading for a very severe recession. I just want to kind of explain briefly the dynamics of that. So the Fed's raising interest rates. We know that they started, so it wasn't that long ago. But March 1st, 2022, the Fed policy rate was 0. It was 0%. People remember Paul Volcker. Oh, Paul Volcker raised interest rates to 20%. Well, he did. But so far, Powell hasn't raised them as high, but he's raised them fast. I mean, even when Volcker was working his way to 20%, it took 3 years. From 1,979 to 1,972. So Powell's plan is clear because he's told us. He said, inflation is job one. It's not that we don't care, but unemployment is going to go up. We're going to have a recession. He doesn't use the R word, by the way, but it's implicit in everything he says. We are going to have a recession. Unemployment is going up, and too bad. It's kind of too bad because we got to get inflation under control. And so the Fed is in search of something that they call the terminal rate. What's the terminal rate? The terminal rate is a rate that's high enough to bring inflation down on its own without further hikes. So it doesn't have to be higher than inflation. It has to be high enough to cause inflation to come down to the Fed's goal of 2% without hiking more. And when they get there to that terminal rate, they'll sit tight. They call it the pause. The pause could be a year. And Powell said this again. This is right out of his script. So Powell is in search of the terminal rate. By the way, if you said to me, hey Jim, what's the terminal rate? I would answer truthfully. I would say I don't know. But now there's Jay Powell. Jay Powell doesn't know what the terminal rate is. Kind of saying, we'll know it when we see it, but we're not there yet, and we're going to keep going. And they have what they call the dots. Silly name. But the members of the Board of Governors and the Federal Reserve Bank presidents give estimates. They're estimates of unemployment, inflation growth, and interest rates for the next 3 years. And they put them as dots on the chart. So they call it Wall Street gets the dots. They do a central tendency and regressions and all this stuff. One of the top Fed insiders practically sits in JPL's lap and has all the way back to Bernanke. Yellen told me personally, he said, inside the Fed, they regard the dots as a joke. They're not better than guesses. The forecasting ability is dismal. You or I would have better forecasts, and they wish they could get out of it, but they don't know how. So that's the truth. But the problem is Wall Street and the financial media and the talking heads on CNBC. They want to talk about the dots, and it does affect market behavior. So even though it's a joke, even though the forecasts are terrible, you have to pay attention because it affects the markets. And if you're affecting the markets, you're on the wrong side. Going to get run over. So I look at the dots, not because I put weight on them as predictive analytic tools, but because the market pays attention. The market says, hey, inflation is already coming down. And so the market says, hey, you did it. You're already there. Inflation is coming down. Why don't you stop? And by the way, you're going to get the message. The economy is going to be slowing down. Inflation is going to be coming down, and then you're going to cut rates. This is the famous pivot. Whenever you hear the Fed pivot, that's when the Fed turns around and starts cutting rates instead of raising them. And that'll be just in time, and growth will slow. It won't be too bad. And we'll come in for a soft landing. And this is the Goldilocks scenario. So again, typical Wall Street, get the pom-poms out. The Fed's going to cut rates and so buy stocks. That's all Wall Street knows is buy stocks. But the conundrum is inflation coming down because the Fed is still hiking? Or is the inflation coming down because they're at the terminal rate? Well, we don't know. It's kind of hard to sort those things out. Powell would say, yeah, it's coming down. I know that, of course, but it's because I'm hiking. I'm going to keep doing it. My view is, no, you actually did it. It's mission accomplished. You just don't know it. That means, as usual, they're going to screw it up. They're going to blunder. They're going to go too far. And it's not going to be a mild recession. Not going to be Goldilocks. In this version, Goldilocks gets eaten by the bears. In other words, you're going to throw this economy into a very deep recession because you're going to go too far as usual. And you're not going to know it until too late. By the time you realize it's mission accomplished, you will have gone too far too long. Rates are going to be too high, and it's not going to be a soft landing. If Wall Street's talking up the stock market based on the soft landing Goldilocks scenario, but Powell's going to stick to his gun and raise rates too high, that's going to cause stocks to crash very severely, very suddenly. If the market were adjusting, say, yeah, pal, means it's going to keep, we ought to come down a little bit. That would be one thing, but that's not what's happening. The market's trying to rally. Powell's warning people what's going to happen, listening, and it is going to happen.